And then I just kept watching it go to 150, 140, 130, 120. Look, this is really interesting. Hey everyone, so I've now had a chance to take a look at a lot of companies' results from Q3, and today I'll do a bit of a speed round, touching on this list that you can see here on the screen. So we got the Naspers, Prosus, Tencent situation, we got Shinoken, Nintendo, Dropbox, OTCM, Berkshire Hathaway, Markel, Skyworks, and Alibaba. Now maybe one of these companies interests you, maybe more than one. There is a company missing here from my portfolio, which is Redbubble, but because they are Australian, they report just twice a year, so we have to wait until February for their results. Okay, now I'm honestly being a bit selfish here, and I chose these companies because I have investments with these companies, but I do hope my work here today can help you because I know we don't have the time to catch up on every company every quarter. So let me go through the things I'd take away from a Q3 earnings report, and look, let's just jump in. We've got a lot to get through. Payetli. Okay, now firstly, I'm not going to explain why I've invested in any of these companies today. I have made videos on those topics before. We just want a quick update so I can stay on top of what is happening and see if there's any red flags jumping out. So starting with Tencent here. Here are some of the important numbers. We've got revenue up 13% from the same time last year, and the non-IFRS profit was actually down 2%. IFRS is like International Financial Reporting Standards or something like that. WeChat grew another 4%, that's up to now 1.26 billion monthly active users. Their book value is up 20% since just December 2020. Now the new regulations and changes hindered the year-on-year growth of Tencent, but the business is still running really well, and the opportunities of growth in all the areas that Tencent plays in, like gaming, music, fintech, cloud, look, the list goes on and on. I don't see any issues here for the company Tencent. This will, I think, all the macro stuff will hopefully shake itself out moving forward, and 5-10 years time, I think we're going to look back at this as an opportunity. Now, of course, I could be completely wrong here, so make sure you do your own work. Now, the Naspers Prosus arrangement owns 29% of Tencent, and that's how I'm choosing to invest in Tencent. Now, the updated net asset value of Prosus is €131 per share, and I think that is pretty accurate. Maybe they are valuing the unlisted assets a bit more than I would, so maybe it's more like €120 per share. I think that feels a bit better for me. Naspers and Prosus is doing really well though. Revenue is up almost 30% for the 6 months. Profit is up 9%. Free cash flow for the period went down, but free cash flow is a measure of maintenance capital expenditures plus growth expenses. And in 6 months, there were a lot of growth expenses, and I'm fine with that. They've also been buying back shares over the past 6 months as well, so that's a nice bonus. I think all is pretty good here. They have great assets, they are growing. It's as simple as that. Look, the macro stuff is hurting the stock price, but if you can look past that, the business is in great shape with probably the best asset in the world in Tencent. And I also like the management team over there, and I'll back them in over the long term. Now today I want to say a big thank you to Thomas Helvig, who is one of my subscribers. Your comments are great, and I appreciate your support. You're a legend. Now Shinoken results look pretty awful at first glance. Across the board, they are down significantly. Sales, operating income, profit, all down like 30%. That is a dramatic drop, and you would think I would be worried. Well, I am a little bit, of course. I'm still human, and I want them to turn this around. But I'm acutely aware that I have a bias and look for the good results to justify myself in this investment as well. Maybe this is a crappy investment. I have to try be honest and methodical here. And if it is crappy, well, I should probably sell. But in saying all that, I'm not panic selling or anything like that. See, when I read the entire report, the management side of the business is actually performing really well. See, there's growth in all areas outside of sales, which is making the business far less volatile than it could have been. It's simply the sales side for the period were far lower than normal. So why are sales down so much? Well, it's because everything got delayed in 2020 with the pandemic. They couldn't grow out their inventory, and this was all expected and forecasted. I think this is why the share price didn't crash on these results. The backlog is actually up 250%, which should translate to better sales in Q4 and beyond. See, real estate developers are in a fluctuating business. I think it is best to look at a multi-year period for results rather than a quarter-by-quarter approach here. But I think if the results are not better by, say, this time next year, then I would be actually concerned. At the moment, only slightly concerned. Staying in Japan, let's now check out Nintendo. So we've seen more share buybacks of about 1.5% from Nintendo, which is nice to see them starting to use their big cash pile. That's generally the criticism of Nintendo, is they are just too conservative with their cash. Having $13 billion sitting in a 0% interest bank account isn't helping the investor like me. Sure, having a load of cash is nice security, but $13 billion is probably overkill, so I'm glad share buybacks are starting to happen. Revenue and profit is actually down 20% on the same period last year, but that was accounted for in the forecasts by the management team. The pandemic was a strange time for gaming and Nintendo saw a serious boost last year. It's just the comparison doesn't look good, but there's nothing wrong with the business. The major news out of Nintendo is that production and shipping is going to be a bit of a problem in the short term with the global semiconductor shortage and the pandemic-related supply chain issues. Do I think the brand or the IP is being hurt though? Not at all. Now, Dropbox had fantastic earnings. 13% increase in revenue year on year. Free cash flow was up 18% year on year. Their paying users is up 8%, growing gross margins as operations become more streamlined, and more paying users growth as well. The company is growing nicely, expanding their product lines, and is well managed. I love the business model and I like the product a lot as well. Eventually the market will take notice, so I just need to be patient here. Now, you might not be familiar with OTCM, but it's the company that coordinates the over-the-counter marketplace. It's not exactly an exchange like the New York Stock Exchange or Chicago Mercantile Exchange. OTC is more of an information service for brokers and people interested in companies listed OTC. Now, this business is growing fast, with user numbers across all parts of the business growing substantially. So 42% revenue growth year on year. Operating income is up 77%. Margins are higher as well. Net income is up 68%. Operating cash flow has actually almost doubled. The dividends have increased as well. But the effective tax rate is actually significantly higher because of some reduction in their expenses. And all this money is translating over to free cash flow, which has grown a lot this year. I don't even think this is seriously overvalued. I did a recalculation using my intrinsic value calculator, and at $40 is good buying. Even at $50 isn't probably that bad. Hindsight's probably going to tell me that I should have bought a lot more at $40 when I bought it the first time. That's okay. I'll be patient. Maybe something happens and the growth slows a bit, or a macroeconomic situation happens, because OTCM is a great business. Now, this video was a massive undertaking to put together. If you could click that like button for me, I would get a warm fuzzy feeling that this video wasn't a big waste of my time to plan out and record. Look, any indication that this video wasn't a complete waste of my time would be greatly appreciated. Now, because Berkshire Hathaway has a big investment portfolio of public companies, well, this value fluctuates all over the place with the stock prices, so earnings per share isn't really the number we should be looking at. The insurance part of their business posted a loss for the period as well, but insurance is also a bit of a wild roller coaster of ups and downs. Operating revenues are up about 12% year on year, and that's a pretty good indicator of what is happening to Berkshire's businesses. So I think the big takeaway here is the now over $50 billion of buybacks that Berkshire have done over the past few years. 20 billion of it has just been done this year. Now, as Investing with Tom has pointed out in his video about Berkshire Hathaway, by the way, go watch that if you want a better explanation, but these buybacks are a bit hidden in the book value valuation. So price to book value of Berkshire Hathaway at the moment is about 1.32, which is right in line with their 10-year average. But if you add those buybacks into the equation, well, the price to book value is more like 1.18, which is well below the 10-year average. At $250, Berkshire would be below 1.1 price to book after adjusting for those buybacks. And that's a pretty good time to enter. Just like Berkshire, Markel's earnings per share fluctuates all over the place because of the investment portfolio and the wild insurance variability. But Markel's insurance operations have been excellent, with a combined ratio of 93%. A very difficult thing to do in today's competitive insurance world. Over at Markel, they run a very tight and brilliant insurance operation. The combined ratio below 100% is essentially saying that they are making more money than they have to pay out in their claims. So 93% is exceptional. Book value for Markel is up 10% in the 9 months so far this year as well. Markel is a conservative compounding machine. Sure, it's not going to give us 30% compounded returns, but historically we'll get 10, maybe 20%. But if we buy at a good price, good returns are very likely over a long period of time. So price to book value is about 1.3 at the moment, and I'd prefer to get that closer to 1 before I buy any more. I think 1.3 is about fair value. All right, now how about this for results? We've got 37% increase in revenue year on year. Earnings per share is up 42%. Expecting about another 15% increase in just the next quarter alone. Look, Skyworks continues to be disrespected and an under the radar cash flow and growth machine. They are set up extremely well for the future of 5G, have a great culture, and market leading products. It's not the cheapest company out there, but it is one of the best. This is by far the most fun company to look at the moment. I've been crushed by the falling share price in a good way and a bad way. See, I've been picking up shares all the way from $220 down to $155, and I just kept watching it go to $150, $140, $130, $120. Look, this is really interesting. I'm down like 40% at least, even after averaging down. And since it's my biggest investment, that's a pretty nasty hit. But let's take a step back here and see what's happening inside the company. Now, revenue is a pretty good indicator of whether the business is growing. Simple as that. And look at all of the parts at Alibaba here on the screen. Can you tell me if this company is not growing? Revenue growth for the next few quarters, the company said they are expecting maybe 22, 23% in that range anyway. This disappointed the analysts who thought 30% was normal for Alibaba. So when looking at this table, I like to focus in on the year-on-year percentage performance. So how much it's improved from the same comparable period last year. So we've got China commerce retail up 33%, their wholesale up 15%, international retail up 33%, international wholesale up 34%, logistics up 20%, consumer services up 8%, and others up 66%. Overall, total commerce up 31% for the quarter on their comparable period last year. Cloud computing is up 33%. Their digital media and entertainment is actually flat. That's okay. It's a slower growth part of their business anyway, but flat's fine. It's not going backwards. Innovation initiatives and others is up 37% as well. So total revenue up 29%. For the 6 months, it's up 32%. So yeah, it's slowed. It's not quite 30%, it's gone down to 29%, but that's probably just normal business fluctuations. I don't think there's anything to worry about here from a revenue point of view. Business is growing across all of their key segments. Now, expenses have gone up with growth as well, so it's not clean profit, which makes sense, and margins have fallen a little bit. I think it's cool how international commerce is growing quickly and starting to help in a meaningful way to the business. But look, earnings per share is where it looks ugly. The investment portfolio has been getting crushed from valuation changes, and there is also increased investment in their growth areas. So look, it's down 82% year on year, and that is one reason why everyone is scared. Then we look at the free cash flow, and that's down 45% as well. But look, free cash flow is made up of growth, capital expenditures, and maintenance capital expenditures. So if it's going down, maybe they're spending a lot more on their growth expenditures, which they have said they have been doing that. So that's probably nothing to worry about too much. Let's see that over a multi-year period. So what do I think of all this? Well, I don't want to be biased here, but I'm definitely being biased because I own the stock. And look, actually that's the case with this entire video. See, you should probably just ignore me, but it's my channel and it wouldn't be interesting if I didn't give an opinion. Look, Peter Lynch would say that the stomach is the most important organ of the body. So I guess this is a bit of a stomach test holding Alibaba as a shareholder. Warren Buffett would say, be fearful when others are greedy and greedy when others are fearful. So how do we know if this is one of those times to just suck it up, buy more, and make a lot of money? Or is it one of those times where the fear and uncertainty and doubt is just completely justified and the business is going down? Well, the company is growing revenues at above 20%, and guidance is telling us that it's going to be above 20% again in the next period. Active users is growing as well, up like 25% year on year. So the business is clearly getting bigger in both revenue and in users, and this growth rates, they're really strong. So I do feel pretty good about Alibaba and what it's doing from a business perspective. I still see people buying stuff off AliExpress here all the time in Ukraine. The company has all these different areas that are growing. Sure, there are some bumps along the road here. but this is not a company that is in financial trouble. And how do I know this? Well, I look at the balance sheet and see this big pile of cash and pretty low debt. I see that although earnings and free cash flow have significantly come down, it is still making a lot of positive money. I see their business segments growing significantly, and I see that money is getting used to grow these areas even further. If you enjoy pain and suffering, then this is probably the stock for you in the short term. Look, I have no idea what's going to happen, but Monish Prabrai would say that being cheap can be a catalyst. So just the price going down lower can make it turn around just because it's going to get so cheap at some point. So I'm just trying to think of the long term here and keep a long-term mindset, and I think I'm going to be more than likely rewarded for that. And I still think anything under about $170 is pretty great buying after adjusting even for that decline in free cash flow. Look, I think there's a lot of upside potential. So if you do like pain and suffering, come and join Charlie Munger, Guy Spear, Monish Prabrai, Robert Vinal, Bill Miller, David Tepper, Prem Watson, Ray Dalio, many other investors, and myself. This is a bit of a value investing party. Maybe we're all going to lose a lot of money here. Well, maybe, but there are a lot of experienced, very rich, contrarian investors on the ship who, well, they know a lot more than me and they know a lot more than probably you. If you're still here at the end, you are super awesome. If there's any questions you have, look, hit me up in the comments. I'll try to get to them as best I can. I might have to start doing a regular Q&A video soon. So if you have a burning question, you can just hit me up there. Well, all right. Well, Merry Christmas, everyone, and I will see you in the next video.